Hey everybody, Peter LeSar here. Welcome back to the Restaurant Strong channel and to our weekly restaurant strategy show. And this week, we're going to talk about Wendy's and the fact that Wendy's has been in the news as a possible business up for sale. And we're going to use the context of a possible Wendy's sale to talk about what you really need to do to lay the best foundations for an optimal sale of your own restaurant business or the restaurant business you're involved in, and how that really works to your advantage. Okay, so I'm going to start by quoting off the cuff Abraham Lincoln, who I'll paraphrase, said the best way to predict your future is to create that future, and that really applies to getting the best possible conditions for the sale of a restaurant business, whether it's a large business like Wendy's or whether it's a mom and pop business in a small town anywhere in the world, okay, or anybody in between. And so paying attention to this video is really important. So before we get started, please do subscribe to this channel, give this a like if it means anything to you. The more people that support the channel, the more people that will benefit from this channel over time as others follow your early lead in, okay? Now, let's move right on to our slide presentation. We're going to use this to guide what you really need to know about selling your business, and we're going to get to the Wendy's context at the end. So, selling a restaurant business starts with understanding valuation multiples. And it's always shocking to me how few people in the business really deeply understand how multiples work, okay, in determining the value of a restaurant business of different sizes and of different and of different levels of income. Okay, so to quote the book Restaurant Strong, which most of you know by now I'm the author of, the vast majority of independent restaurants would be valued by credible buyers at multiples of 0 to 3 times EBITDA. Okay, so I'm not going to define EBITDA in detail for you. It is earnings before interest, tax, depreciation, amortization. But for those not familiar with the term, think of it as sort of your net cash flow or your owner's take. These are your net operating income pre-tax. These numbers are all fairly similar, okay? And so essentially, most independent restaurants these days would sell between 0 and 3 times whatever their net operating income is or their EBITDA, okay? And every year, a handful of small restaurant groups or chains, now not talking about individual independent restaurants, but small restaurant groups or chains with maybe 5 to 20 restaurants in total, are valued at up to 8 times EBITDA because they can show high growth future same-store cash flows, okay? So what I mean by this is that there is a first tier of restaurants, of independent restaurants that might have 1 or 2 shops, okay, that will generally get a lower valuation in terms of the multiple of their EBITDA, okay? And then there's a next tier, which are those that have 5 to maybe 20 stores in total that can move all the way up from 0 to 3 to as much as 8 times, okay? Because they are able to show that their same store cash flows are still increasing at higher rates than the market, okay? We're going to come back to this in detail in a moment, okay? So, and they have also proven their potential creating new cash flows from the addition of new stores. And so the reason that small chains and small groups can get higher valuations is based on the higher cash flows of their same stores, but also they have proven that they can open up new stores successfully and replicate the sort of cash flows that they generated in those earlier stores, okay? In other words, collectively, they have a business model that is outperforming that first group, okay? So that is really important. The way to get to higher multiples over time, to get to that next tier of multiples, is by having a proven business model. And a proven business model is one that grows more quickly than other restaurant businesses can and has proven itself to be replicable, excuse me, in various environments. Okay. And if you have not achieved that, you're going to be in that first group, okay, of 0 to 3 times, pretty much a guarantee. Okay. Now, those are the first sort of 2 levels or tiers that one can aspire to when selling the restaurant. And there are some other layers between that and a publicly traded company, but for now, I'm just going to go straight to Wendy's, and I want to look at their multiple. Okay. So, excuse me, as you probably know, when you're looking at publicly traded equities, okay, stock market, they trade on a price to earnings basis, okay? And earnings also has its own definition that is different than EBITDA, but for now, we're just going to assume they're all roughly the same, okay? And if you look at this arrow to the right, as of the last few days, Wendy's was priced at roughly 20 price to earnings basis, okay? Not a 0 to 3 times EBITDA or a up to 8 times EBITDA, right? And so this final tier of publicly traded companies has much higher multiples because they have really shown that the risk that they will not be able to continue to produce high cash flows is a lot lower than the risk of group A or group B, okay? And they've shown that they can continue to replicate their stores, right, over and over and over again. And that is also a better risk reward scenario than group A or group B. And that is why they get much higher multiples than either of those 2 groups. Does that make sense? And so investors are really looking for what is the risk reward scenario of each different level of scale of a restaurant business to determine the multiple that they, or the range of multiples they might consider. Okay. So valuation multiples are based on scale of business, which determines the risk level tier. Okay. 0 to 3 times for small independent businesses, up to 8 times for those that are maybe 5 to 20 stores, and 20 times or maybe even more in certain scenarios. We'll get into that in a moment for restaurant businesses that have made it all the way to publicly traded companies. Okay. And there are series of investing rounds between that sort of 8 times and the publicly traded company level where you might have multiples that are even higher than the 8, but lower than that on the publicly traded sort of price to earnings basis. Okay, so valuation multiples are also based on growth rate of the business, meaning revenue growth rate, which determines the opportunity level, right? And so it's not just that the risk that the existing cash flows are going to go away determines what the multiple level should be, but also the reward that is available, because if I buy in at this level and they're growing at faster than the marketplace, I know that the value of what I'm buying is going to be worth a lot more compared to other investments I might consider in the coming years, right? Because the entire investment community is made up of risk, reward, and greed, right? So I want to actually be able to invest in the best financial outcomes for myself or for my institutional clients, etc. Okay. Now, this is also a quote from the book. Your revenue growth rate year after year must always outperform those of your direct competitors. Why is that? Because that makes you more attractive to investors, whether you're selling or raising equity, etc., as it has a knock-on effect for all financial outcomes you care about, right? Including getting the best price for your business, right? But also for being able to hire talented people because they want to be able to participate in a growth business where they will have more opportunities for themselves over time, right? And so revenue growth rate is really part of this 2-tier of analyzing what a business is worth, but the revenue growth rate also has additional knock-on effects, okay? Now, selling a restaurant business continues with understanding valuation cycles. So we've just looked at valuation multiples, but we also have to understand that when you sell a restaurant business, where we are as a globe, okay, as a planet, in the market cycle can affect what sort of pricing you can get. Okay, so this is the same price to earnings chart for Wendy's that was from last week, and I told you at the arrow on the right it was having a PE ratio of roughly 20 times. Okay, but in June of last year, a year ago, it had a price to earnings ratio of 45 times. Okay, so its price to earnings ratio has fallen by half in 12 months. Okay, and this is not just Wendy's. If you look at McDonald's, McDonald's is at 24.75 today. It was at 33.5 just 12 months ago. If you look at Domino's, it's at 29 today. It was at 43 just under a year ago at a local top. And so what you can extract from that is that this is not just about the performance of individual businesses, but that the restaurant sector in general, and perhaps even the whole market, is facing a similar phenomena where businesses or equities are losing value. And that has everything to do with what sort of price range you might be able to get for your own restaurant business today. So let me explain that. Excuse me. So when the globe is in a risk-on scenario, and I'll explain that in a moment, and there's lots of liquidity for investment, excessive liquidity for investment, the multiples that get paid for businesses are higher, okay? And when liquidity dries up, okay, and this affects small businesses as well, as I'll explain, and we move into a risk-off scenario where people are worried about investing, what investors will pay for businesses in terms of a multiple of cash flow or EBITDA, et cetera, is actually lower. Okay, and so when you sell your business, what part of the cycle you sell your business in is really important to how much you're going to get for that business. Okay, so valuation cycles globally are mostly determined by the U.S. Federal Reserve globally. Okay, and I'm not going to get into that today, but there are other videos where I've alluded to this before, and we talked a lot about this in our Facebook community, Restaurant Strong. So we are either risk on or risk off, and this cycle will determine where you are within your multiple range, right? Most people know we've had really high inflation. Most people know that the U.S. Federal Reserve has been forcing up interest rates, right? And they are now starting to move from quantitative easing to quantitative tightening, where they're actually reducing the money supply rather than increasing it. That's the goal anyways. We'll see how far they get with it. And those conditions are moving investors from having excessive liquidity and chasing businesses and being willing to pay higher multiples versus not having enough liquidity and negotiating for more favorable multiples as an investor. Okay, and this has everything to do with how much a restaurant business in June of 2022 could get versus for its business versus in June of 2021, okay, as an example. Okay, so achieving your financial goals requires that you understand these critical takeaways. The first is I want to talk about Wendy's. So we've all heard, because it's been in the news, that Wendy's might be up for sale, but it's not Wendy's, the company, saying we want to sell. It's Wendy's largest shareholder, which has about 19% of the company, that is saying we might want to buy the remaining shares of Wendy's in conjunction with other investors. Why would they do that? Okay, well, because they know that the price earnings ratio of Wendy's today is less than half it was a year ago. It's at the bottom of the cycle, and investors want to buy at the bottom of the cycle so that they can ride the wave up, okay, as the cycle improves, right? And so you don't want to get caught up in that. You don't want to get caught in selling cheaply to somebody at the bottom of the cycle, which is basically where we're heading right now. And then 2 years later, the cycle's backed up and they're able to take a profit from your selling at a reduced rate. Okay. Rather, you want to do the opposite. You want to be able to sell at the top if your plan is to sell. Okay. So to achieve your highest possible multiple and best exit, you must sell at the top of the cycle. And that means you need to be watching what the public markets are doing and what the Federal Reserve is doing, and when there is buoyancy in valuations again, because that will mean you're getting to a point sometime after that where people are going to be really have a lot more cash flow available, or liquidity available, I should say, to make investments, and they're chasing deals and paying higher multiples as a result. Okay. But also, to achieve your highest multiple and best exit, you must learn to build and sustain the highest revenue growth rates possible. If you don't do that, then you're still going to be hurting in terms of where you are in the multiple range, because even if the market is doing really well and you're selling your business, but you basically have no growth, it's more likely somebody's going to pay you a 1 times multiple if you're a small independent restaurant rather than a 3 times multiple. Okay. You need to have that high revenue growth rate to prove to people that when they are buying you, they can expect continued growth, so that they are in the money, within a year or two, where the business is going to be even more valuable. Not that it's a flat business and they're paying $100,000 today or $1 million today or whatever it is, and it's still only going to be worth that in a year or two, right? You need to prove to them that actually, just based on the way revenue is trending, their investment is going to be worth a decent amount more within a couple of years. Okay. And you want to do that at the top of the market. Okay. So that is our brief strategy session for this week on Wendy's and selling your restaurant. If you have more questions about how to sort of build growth rates and how to position your business for sale, then remember, I am the author of the book Restaurant Strong. You should go ahead and buy that and read that. And there's information below at my website if you want to understand a little bit more about how I help restaurants to do the same. Have a great week.